Hugh, welcome to the show. Great to have you with us.
Thank you.
So we see signs of, perhaps you could interpret it as goodwill on both sides. Is this something you'd want to jump on in terms of turning more risk positive? Because we've kind of been here before where we see positive signs and then we see escalation again.
So I think it's a step in the right direction, certainly, and markets have taken it well. I'm slightly more cautious about stepping into this too aggressively because I think, as you say, this is the ebb and flow of negotiations that we've seen for some time. And at the base of this, there are structural issues that really, I think it's going to be hard to find common ground on. So I'm a little more reserved at this point.
So when you speak to investors and you advise them on how to invest around the trade war, if at all, what are you telling them right now?
So I think the challenge is you have two very binary outcomes, and we've seen from markets over the past few days the way in which sentiment can shift very quickly. And so for us, when you're faced with such different outcomes as the trade issues, it's about really not trying to make heroic calls on one side or the other and thinking more about a broadly balanced approach.
Yeah, I mean, speaking of sentiment, if you take a look at the AAII bull-bear spread, and a lot of people do watch this quite closely, investors have turned positive on that for the first time in 6 weeks. Does this actually make you more cautious about joining the rally in the US? The S&P 500 yesterday closing above 3,000 for the first time in 6 weeks.
Yeah, so I think you have to question whether now is really the right time to be adding aggressively to equity allocations. That said, I do think that if we do see more incrementally good news on the trade side, then this rotation could continue for some time. So out of the winners of this year, so the momentum stocks, the minimum volatility stocks, and more into value.
Yeah, you think that could continue, what we've seen over the past couple of days or so?
I think the news that we've had overnight certainly supportive of that. But as I say, I would be reluctant to read too much into the latest news.
Yeah, I mean, that rotation from momentum to value has kind of tracked what's happened in Treasury yields as well. Curve steepening and a backup in 10-year yields. I mean, today we do continue to back up a little bit on the general sort of risk on. I know that JPMorgan recently revised down their 10-year Treasury yield called again, I believe from 175 to 150. Is that something you'd want to sort of hold right now, or do you think that actually we could see a little bit more move to the upside for yields?
I mean, there are lots of different views at JPMorgan, obviously, but I think from my perspective, the weight of demand that we've seen in fixed income markets this year is here to stay. And so I think backups in yields, if we were to move closer to 2%, I think you'd see significant demand stepping back in at those levels.
So you'd be advising to buy the dips really in Treasuries?
I think there's a significant place for Treasuries in portfolios today in a multi-asset context. They're still offering that diversification and that sort of protection for investors if we see and further escalation in trade, or if we see just a simple weakening of the macro data. I think there's certainly merit for Treasuries in portfolios.
Right, and would that be more on the longer end, duration, or more cash?
No, so I think the longer end, if you're looking for Treasuries to be offering real diversification, I think you do want to be taking on an element of duration.
What's interesting as well in terms of Treasuries and US debt markets is the comments that we had from President Trump yesterday saying that the Fed should be taking rates below zero. I mean, you do wonder how much President Trump does sort of use the rhetoric around the Fed to fuel the next steps in the trade war with China. But is this something that you can see happening at all at any time, say in the next 2 years, that rates in the US go down to zero or even below?
So I think if you look at the administration's agenda, they've really focused on 3 areas. So they want a strong stock market, they want a strong economy, and they want to be strong on China. And I think the Fed is really the valve for them to try and put all of those 3 pieces of the puzzle into play. Now, I think as well, outside of the pressure coming from the administration, the Fed are watching the macro data, as we all are, and are seeing reasons to take a slightly more cautious stance. And so I do think the path of rates is lower. As to whether we get towards zero, I think we'd need a significant deterioration from current levels to get there.
Do these latest signs of goodwill that we've heard about in the past 24 hours change anything beyond the September meeting for the Fed? I mean, the 25 basis point rate cut for September is pretty much fully expected by markets. Does this put a question mark over that or any subsequent meetings at all, the latest developments?
I wouldn't read into it too much at this stage because I think we've seen these negotiations can turn very quickly at the same time. And so the Fed have told us all throughout this year they want to be extremely data dependent and that they'll be treading very carefully in the run-up to any meeting. And so for me, the September cut certainly looks very likely at this stage, and potentially one more between now and the end of the year, with a second possible if we see the macro deteriorate more quickly than I would expect.
What would a Fed disappointing the markets look like to you?
So I think you would see a backup in Treasury yields, and I think you would see a broad disappointment from risk assets, because one of the biggest supports of both the equity market and credit markets this year has been that pivot from central banks to a more dovish stance. So I think it would broadly be taken as not particularly good news for risk assets.